Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. If you guys are looking for some undervalued investment opportunities, click subscribe. It's the best way to get updates on what I'm going over. So today I want to go over ratios, and ratios it's a very simple comparison. So basically, whenever you want to look to see what assets sell for, what you usually do is you do a comparison analysis. You do benchmarking. You do some sort of analysis where you look at the market and you say, this is what the assets are being priced at today. And then you say, this is what this one is. And then you do your comparative analysis to see what the pricing should be. That's all ratios are. So ratios is just taking an asset versus an asset. You divide them by each other. You get a ratio, which is a numerator and denominator. So it could be a gold to silver ratio, some sort of ratio, and then you compare that to history. So what you're doing is you're taking out the dollar pricing. The dollar pricing is not a very good way to measure a valuation of an asset, because the dollar, if it's a measuring stick, is moving all over the place. It's getting longer, shorter, smaller. The value of the dollar is not stable. So it's not a good way to value something. So in this particular clip, we're going to talk about ratios. And I'm going to show you some of the ratios over time and what they mean, some of the charting and whatnot. So let's jump in. We can talk ratios today and see what's cheap for investment opportunities. So ratios, the only thing that really tells us value is ratios. We want to purchase items that are undervalued compared to history and are bottoming and are about to turn back up. That's like the perfect scenario. We are looking for stores of value that can increase our purchasing power over time. That's our goal. Our goal is to increase our purchasing power or wealth. So here's the Dow to gold ratio. This is what it looks like. And we've got the 1913 line here. Before 1913, this is what the ratio looked like. It was going in an upward trend, which means that the Dow was increasing at a faster rate than gold, and it could purchase more and more gold over time, which means that that on a very long-term perspective, that stocks were stable and could outperform gold over time. Now, on the right-hand side, which is the 1913 and over, when the Federal Reserve went into power, they're creating larger and larger volatility in the markets. We're getting larger booms and bigger busts, larger booms and bigger busts. And we're getting these gigantic fluctuations of Dow to gold ratio over time. So a lump of metal did a better job, which is the gold standard, without a Federal Reserve, and actually had a more stable market. Now you have to know what cycle you're in, because this is like a boom and bust cycle, the boom cycle and the bust, the boom and then the bust. And they're very large boom and bust cycles. Back here, these cycles were very small. So you could basically go through an entire investing career of someone's life and kind of just ride it up in stocks. Now, the boom and busts are so large and they last so long that you could have 20, 30-year periods where you have massive crashes. And right now, what I think is coming up, looking at this ratio, is that we're going from a high Dow to gold ratio down, which means that gold's going to outperform stocks in the intermediate to long term. So that's where I'm looking. I am looking for investment opportunities where one asset's going to outperform the other asset. And according to this, Dow is expensive to gold, in that we would probably see an outperformance of gold. Now, here is the commodities to S&P 500 index. We are at 0.05, and I'll show you on the next slide what that looks like. We are down here in no man's land, which means that commodities are extremely cheap in relationship to the S&P 500 index, and that commodities are probably a very good investment opportunity. Now, one thing I do want to say is that commodities have been cheap since the 2015 to 2019 period, and they are still cheap. So one's going to have to be patient. But the the ratio is very favorable. Never been this favorable for commodities. And at the peaks, they're typically around 8. The peaks up here. And right now we are at 0.05. And we just broke the downtrend of this downtrend. We're kind of coming up. We broke up, kind of back tested, and we're coming back up. So we've got some strength coming up. COVID definitely sold this thing off to a capitulation kind of bottom here. And we're at 0.05. So if we look back here, 0.05 is like at this zero mark, basically. It's never been this cheap. So commodities in relationship to stocks is an incredible opportunity. Incredible. It's never been this large of an opportunity ever. So that's one thing I wanted that this is the CRB index versus the S&P 500. It's all the way down there. Now, some calculations just to give you guys some analysis, some calculations. So the average over history is 3.9. 3.9 is this average number right here. That's the average for what the commodities to S&P 500 should be, roughly. Now, we are at 0.05 right now. And in order to get to the average for the commodity CRB index in relationship to the S&P 500, the CRB index would need to outperform the S&P 500 by a factor of 78 times. So what that means is if we were to go back to the average and you were in commodities, that would have to outperform. Commodities would have to outperform the S&P 500 by a factor of 78x, which means your purchasing power against the S&P 500 needs to increase by 78 times to get to the average. The average of this past 30, 40, 50, 60 years. Now, if we go back to the highs, remember the highs were somewhere around 8. That's about the highs here. Now, if we were to go back to highs or make a blow-off top in the future, because of such undervaluations that we have today, we could see an outperformance of commodities to the S&P 500 of 160 times. That means that your $1 in commodities could eventually buy 160 times more S&P 500. That makes sense. It is a very large undervaluation and anomaly in history for commodities to be this cheap in relationship to stocks. And vice versa, if you're in the S&P 500, you're going to buy a lot less commodities when this valuation reverses. So commodities are the spot to be. Commodities are the most undervalued they have ever been in over 100 years. The opportunity is right in front of us. It is here now. The CRB index is bottoming and starting to turn higher. I'm looking at this as an investment that will be at a minimum of 8 to 15 years in length. I don't know if it's going to go past that because a lot of these commodities could go much further into the future than 15 years because of the dynamics. So we are buying at generational lows. So I'm going to release another ratio analysis video after this one to show you guys. What I'm going to do is, we know that commodities are cheap in relationship to stocks. Commodities are cheap to everything. I'm going to sift through some of these commodities to see what's cheap in the commodity sector, but they're all cheap overall. So we're just looking for the best opportunities and how cheap they are in the commodity sector to see what undervalued investments are out there that we could potentially partake in. So this is the type of analysis that I do and I look at on the channel to see relative value. And relative value is really the only thing that you can do to increase purchasing power gains. You have to buy the undervalued asset and have the assets change back over time. You can buy an overvalued asset and have it become more overvalued, but it's a lot higher risk and your returns are going to be a lot lower. You want to look for the least risk, most asymmetric bet that there is in the market. Commodities is that largest asymmetric bet where it can create value for the shareholders if you're buying stock or even if you're buying the actual physical commodities. It has the largest opportunity for returns against other assets. And that's the only way that you can increase your wealth. You have to be in an asset that's cheaper that can buy more of another asset later. That's the only way, because you can't have it go backwards. You can't buy an overvalued asset, have it go down against other assets and make purchasing power gains. You can have fictitious paper gains which do not materialize in purchasing power gains. So you can go up 10% in an asset, but if all the other assets go up 40%, you can't buy more of those other assets. So you lost purchasing power gains, even though you made a quote paper gain in the dollar measuring stick, fiat currency, measuring stick. So this is what we're looking at. It's commodities is the cheap thing. I'm going to go into another presentation on ratios and show you what commodities are dirt cheap and how these guys are interacting with each other. These ratio presentations are probably some of the most important ones, because if you can understand the ratios inside and out, you know what's cheap, you know what's expensive, you know how they interact with each other. That's where you make your purchasing power gains. That's where you can change your life. You can change the generations behind you even. That's how much money that you can make over time. So hopefully you guys like this presentation. Give me a thumbs up if you like it. Look for that other presentation of ratio analysis coming out. I'm going to talk about it. We'll go over a bunch of charts and whatnot, and I can give you my opinion on what potential commodities are some of the best opportunities. Thanks for listening. This is Finding Value.